Thanks for your company here on Business Now. Well, quite clearly overnight, the Federal Reserve increased its official discount rate by 0.5%, and that overshadowed another move it made, and that was to say it would start selling government bonds it's acquired as part of its quantitative easing program. Now, Australia is clearly on a similar but slightly different path. To explain, let's bring in here Jonathan Sheridan, the Director of Fixed Income and Investment Strategy at the Fixed Interest Specialist FIG Securities. Jonathan, many thanks for your time as always. Can you just first off explain the subtle difference between the way the US is doing this and what's happening in Australia?
Sure, Ross. Thanks for having me. So, as you noted, the US is taking a slightly different path, and they will actively be selling the bonds that they bought as part of their QE program into the market. And they will obviously be doing that on an ongoing basis at a predetermined rate per month. Whereas the RBA are taking a slightly different path, and they will just allow those government bonds that they bought as part of our own QE program to mature, and then they will not be reinvesting the proceeds.
Okay, so we should explain to people, QE, this is effectively the money printing. This is the central banks buying back the bonds from pension funds, from superannuation funds, from banks themselves to basically put that money back into the financial system during the COVID recession. That's what it was all about, wasn't it?
Yeah, look, I mean, there's clearly levels of these things, and it can get a lot more complicated than that. But essentially, yes. So what the idea is that the central bank buys bonds and exchanges them for cash. And then the idea is that cash then finds its way out into the general economy to support people and businesses through the economic correction that we saw due to the shuttering of economies due to the pandemic.
And also because interest rates were so close to zero, the other alternative was to go to negative interest rates, which they didn't want to. Okay, so the problem, as I see it, though, is all of a sudden these central banks have massive amounts of these bonds on their balance sheets that are clearly, as interest rates rising, going underwater. They're actually technically in a loss situation. So this is, again, a way in which by selling those bonds, they can take cash or money out of the economy and really, just like interest rates, start to tighten up, if you like, the actual movement of cash around the economy.
Yes, indeed. I mean, I've read various different articles from various different people saying around the sort of $400 billion US mark is equivalent to about a 1% rise in interest rates. So exactly as you said, rather than go to a negative overnight cash rate, the way to stimulate the economy and get the effective interest rate lower was to buy the bonds. And now we're selling them, it'll be the opposite effect. So it's equivalent to more tightening and more increasing of the cash rate by selling those bonds.
Okay, so that's in America, where it's said that the portfolio of bonds that the Federal Reserve holds is around $9 trillion or $9,000 billion. So from that point of view, here it's said to be around $350 billion. But let's just go to the tape now and hear Jerome Powell from overnight just explaining that strategy of selling those bonds back into the market in America.
Against this backdrop, today the FOMC raised its policy interest rate by a 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet.
Okay, so that's America, but you say that what Australia are doing is subtly different. They still call it quantitative tightening, though, don't they?
Yeah, they do. I mean, I think it is slightly different in that they won't be selling the bonds into the market. They'll just be holding them, and then when they mature, they will receive the funds back from the issuer of those bonds, and then they will not be reinvesting them. So it's a slight change. It still basically means that there's less cash being pumped into the economy by the central bank. The interesting point that you made earlier about the fact that with the yields on those bonds having risen, the price is now in an underwater position compared to where they bought them, which is relevant for the US situation because they will obviously be selling those bonds back into the market at a lower price than where they bought them. But for the RBA, particularly they bought a lot of bonds at the 3-year point on the government curve because they were trying to control that 3-year government yield. They still bought them at a positive overall yield of 0.1%. So even though currently they might be have a market price of under where they bought them, by allowing them to mature, they will still receive a positive return of 0.1% on the yield overall, and therefore there shouldn't be any issues with the RBA taking a loss on those bonds.
Yeah, we'll come to that because clearly those 3-year bond yields are now above 3%, not 0.1% when they were buying those bonds. But let's just go to Philip Lowe, the Governor of the Reserve Bank, on Tuesday this week, just explaining that subtle difference in that Australian strategy.
We also decided that we would not reinvest the proceeds of maturing government bonds. This means that our bond holdings and our balance sheet will decline as the bonds mature. Our balance sheet will also decline substantially in 2023 and 2024 as banks repaid the funding made available under the Term Funding Facility. This contraction of our balance sheet will contribute to some tightening of financial conditions in Australia, and so it will assist with the return of inflation to target. The board currently has no plans to sell the government bonds that it's purchased during the pandemic, and it intends to allow the portfolio of bonds to run down in a predictable way as the bonds mature. This decision to proceed with quantitative tightening does not rule out a return to quantitative easing sometime in the future, should circumstances require that.
So, Jonathan, just in regards to what they're doing in selling these bonds, does it have any impact on the future interest rate decisions that they might make?
Yeah, look, I think they take all of these things into account when they're setting their cash rate policy. And what they're really looking to do is essentially just destroy demand. With all the stimulus that was thrown at basically everyone by governments and central banks throughout the world in the midst of the pandemic, they now want to wind that back and make financial conditions less accommodative. So it makes people make a harder decision about whether they borrow money because it costs them a lot more to borrow now. And that's the end goal here, is really about tightening financial conditions and bringing demand down. Because, to be honest, the central banks don't really control as much of the inflation that they would like to think. And so they're trying to basically stop people spending. So, you know, if there's a supply chain issue causing inflation that you can't get a chip for a car or whatever, and car prices have gone up, they just basically want to make it more expensive for you to buy that car if you're borrowing money to do so. And so you won't buy the car and then reduce the aggregate demand and hope that that takes the heat out of the wider economy. And that's the way that they bring inflation down back to their target.
Jonathan Sheridan from FIG Securities, many thanks for your time here on the program today.
Thanks, Ross.